Okay, welcome to the deep dive. It's just you, me, and our expert guide here. We're ready to cut through the noise, get straight to what matters. Today, we're really diving deep into the absolute starting point, the bedrock for the ACCA Financial Reporting exam. That's SRR. Think of this as exploring, well, Chapter 1 of your FR journey, the real foundations laid out in the syllabus. We're pulling all our insights directly from this source material. Specifically, that's the official ACCA FR syllabus and study guide for September 2025 to June 2026. And also a helpful visual overview document that kind of lays things out. Our mission, well, is to take these foundational concepts of the conceptual and regulatory framework and really unpack them. We want to extract the most vital bits of knowledge, helping you understand not just what they are, but crucially, why they're so essential for mastering financial reporting and, of course, passing that FR exam.
Absolutely. And understanding this material, it's really fundamental. It's definitely more than just memorizing rules for an exam. This builds directly on the knowledge you gained back in financial accounting, or FA, but it takes it quite a bit deeper. We're moving from just doing the accounting to really understanding the principles and the purpose behind financial reporting itself. And, well, if we look at the bigger picture, the FR syllabus fits right into the core of the whole ACCA qualification. The structure, you can see it shows FR taking those FA fundamentals and providing a really critical link forward. A link to strategic business reporting, SBR, strategic business leader, SBL, and even audit and assurance. Mastering FR is truly, it's a cornerstone paper for progressing in ACCA.
Right, a cornerstone. And the syllabus structure itself, it kind of signals a shift, doesn't it, in how you're expected to engage with the material. While FA, as you said, was assessed mostly at level 1 knowledge and comprehension, FR steps things up. It's assessed predominantly at level 2, which is application and analysis. Now, you'll still need that level 1 knowledge, obviously, but the exam questions will really push you to apply that knowledge and analyze scenarios,
Right.
which is exactly why understanding the why behind the rules is just so crucial.
Precisely. You've hit the nail on the head. So let's really dig into syllabus section A then. This section is titled The Conceptual and Regulatory Framework for Financial Reporting, and it's exactly where the study guide kicks things off.
Okay, let's unpack this first bit then. Section A starts by talking about the conceptual framework itself. The study guide asks right away, why do we even need one? What exactly is it, and what purpose does it serve?
Well, at its heart, a conceptual framework is basically a set of underlying concepts and principles. These guide the development of accounting standards and practice. Think of it like the theoretical foundation, or maybe the Constitution, for financial reporting. The sources really highlight that without it, standard setting could become, well, a bit arbitrary. Financial reports might lack consistency, comparability.
Which would make them pretty useless for users, right?
Exactly. It would make it incredibly difficult for users to make informed decisions. The framework provides that essential underlying logic, that consistency.
That makes sense. It's about bringing structure, some reason, to what's a pretty complex process. And the framework isn't just about how to account for things, is it? It's also about what makes the information useful in the first place. This is where those qualitative characteristics come in.
Exactly right. The framework identifies the qualities that make financial information helpful to its users, and that's primarily investors, lenders, other creditors. And it splits these into two main groups: fundamental and enhancing characteristics.
Okay, and here's where it gets really interesting, I think. The study guide really emphasizes two characteristics as being absolutely fundamental. These are relevance and faithful representation, the non-negotiables, essentially.
Yes, those are the big two. Relevance basically means the information is capable of making a difference in users' decisions. It has predictive value or confirmatory value, maybe both, and faithful representation. Well, that means the information depicts the economic phenomena it purports or claims to depict. It needs to be complete, neutral, and free from material error.
Mutual is key there.
It is, and the sources specifically challenge you, the student, to consider whether faithful representation is more than just sort of mechanically ticking boxes and complying with IFRS accounting standards. It's really about reflecting the economic substance of a transaction, not just its legal form.
The substance over form idea. Yeah, that's critical, isn't it? And often a point students find tricky.
It really is. It adds that layer of professional judgment, going beyond just following a checklist. If you just follow a rule, but the result actually misleads users, well, you haven't achieved faithful representation.
Fair point. It's about the outcome, the truthfulness.
Absolutely. And while those two are fundamental, the framework also lists these enhancing qualitative characteristics. These are understandability, verifiability, comparability, and timeliness. They don't make unusable information useful, but they improve the usefulness of information that is already relevant and faithfully represented.
Okay, and comparability stands out because the study guide specifically mentions it when talking about changes in accounting policies. You need to know if a company changed how it accounts for something. Otherwise, comparing its performance this year to last year becomes, well, impossible.
Yeah, exactly. It's like trying to compare, as you said, your apple harvest one year to your orange harvest the next in a consistent basis. Comparability isn't just about comparing company A to company B either. It's also vital for comparing company A over time. And changes, while sometimes necessary perhaps for better faithful representation, must be clearly disclosed and explained so users understand the impact.
Right, transparency is key there.
Yeah.
Okay, so the framework gives us the purpose and the qualities of useful information. The next logical step seems to be figuring out when items should actually be included in the financial statements, and then how we put a number on them. Which brings us neatly to section A2 in the syllabus, recognition and measurement.
Correct. Recognition is the process of capturing an item in the financial statements. That item has to meet the definition of an element like an asset, liability, equity, income, or expense. And it has to meet the criteria for recognition. The sources outline these criteria. Generally, it's recognized if it's probable that any future economic benefit associated with the item will flow to or from the entity. And the item has a cost or value that can be measured reliably.
So probable economic flow and reliable measurement.
Essentially, yes. It's deciding if an economic event is significant enough and memorable enough to be formally included in the balance sheet or income statement.
Got it. And once you've decided to recognize something, you then have to measure it and put that number on it. The study guide lists several measurement bases in A2s: historical cost, current cost, value and use fulfillment value, and fair value. Quite a few options.
It is, and this is where the framework really highlights a core tension in accounting practice. Historical cost, what you originally paid or received, is often seen as objective and verifiable. It's a fact.
Easy to prove.
But it can quickly become irrelevant, especially in times of changing prices or inflation. What you paid 5 years ago might not reflect today's reality. Fair value, on the other hand, aims to be more relevant by reflecting current market conditions. But the downside is it can be more subjective, harder to verify, especially for unique assets that don't have an active market.
Ah, okay. So the study guide, asking about the advantages and disadvantages of historical cost and whether current value fixes everything, it's really probing that fundamental trade-off, isn't it, between reliability and relevance?
Exactly. It's not a simple choice. There's no single best answer for everything. There are valid arguments for using different methods depending on the specific asset or liability and the objective of the reporting. It's a fundamental challenge, and the framework provides the principles to guide how specific IFRS accounting standards select the most appropriate measurement basis.
All right, so we have the conceptual foundation, the qualities of useful info, and how items get recognized and measured. But who actually decides all these rules? Who makes the standards? This leads us, I think, to section A3, the regulatory framework. Why do we need this formal structure anyway?
Well, the sources explain that a formal regulatory framework is needed to ensure consistency and enforce standards across different companies. This makes financial statements comparable and reliable on a much wider scale nationally and internationally. Without regulation, imagine the chaos. Companies could use vastly different methods, making comparisons impossible and potentially misleading investors.
Fair enough. And the global regulatory framework that centers around IFRS accounting standards, right? Set by the IASB, the International Accounting Standards Board.
Yes, that's the main body for international standards. The study guide discusses the advantages of having a single set of global standards like IFRS. The main benefit being increased comparability across international borders, which is huge for global capital markets.
Makes sense.
But it also touches on potential disadvantages compared to purely national frameworks. Things like potential complexity for smaller, non-listed entities, or challenges in applying standards primarily developed for large listed companies to all entities globally. And the sources also make an important point. IFRS accounting standards themselves, while very comprehensive, are not the complete regulatory framework. National laws and stock exchange regulations also play a significant role.
Okay. And there's also this distinction made between a principles-based framework, like IFRS aims to be, and a more rules-based one. The study guide asks if they can actually work together. That's A3C.
Yeah, that's a classic debate. A principles-based approach sets out broad principles and relies heavily on professional judgment and application. The goal is faithful representation of the underlying economics. A rules-based approach, common in some jurisdictions, provides very detailed prescriptive rules like a checklist.
Easier to follow, maybe, but less flexible.
Perhaps. The debate often pits the flexibility and economic reality focus of principles based against the consistency and perhaps auditability benefits of rules-based. The sources seem to imply that a good framework probably needs elements of both strong, clear principles supported by enough guidance to ensure consistent application, but without completely stifling professional judgment when needed.
A balance, then. And setting these standards, IFRS standards, it's quite a detailed process, isn't it? The study guide outlines the IASB's due process.
It does, yes. It's designed to be a very transparent and consultative process. It typically involves identifying an issue, maybe research, then developing a discussion paper or an exposure draft for public comment. They consider all the feedback they receive on that draft, potentially revise it, maybe issue another draft, before finally issuing a new or revised standard. This whole iterative process, including involving national standard setters and other stakeholders, aims to ensure that new standards are well considered, robust, and address real-world reporting issues effectively.
Right. It's not done in isolation. Now, a really significant development that's highlighted in the sources, in the summary of changes section in that visual overview doc, is the introduction of the International Sustainability Standards Board, the ISSB, and IFRS S1. Section A3F in the syllabus specifically asks about the purpose and role of the ISSB. What's the story here?
This is a major development, absolutely. It reflects the evolving demands on corporate reporting, moving beyond just traditional financial numbers. The ISSB was established under the IFRS Foundation alongside the IASB, specifically to develop a global baseline of high-quality sustainability disclosure standards. Its purpose, as the source material states, is to meet the information needs of investors and other capital market participants regarding sustainability-related risks and opportunities that affect a company's enterprise value.
Okay, so the key link there is enterprise value. It's not just about general sustainability concerns, but how those specifically impact the company's value from an investor's perspective.
Exactly, that's the crucial connection. It integrates sustainability matters directly into the scope of information relevant for financial decision-making. And IFRS S1, which is the first standard issued by the ISSB, is described in the syllabus, A9F references this, as an underpinning standard. Its objective is to require a company to disclose information about its sustainability-related risks and opportunities that is useful to primary users, investors, lenders, etc., when they're making decisions about providing resources to the company.
So what kind of information does S1 cover?
It sets out general requirements and guidance on the core content for these disclosures. It covers 4 main pillars: governance, strategy, risk management, and metrics and targets related to sustainability.
Wow, okay. That feels like a significant expansion of what traditionally falls under financial reporting. It definitely ties back to that idea that the framework is evolving to meet changing information needs.
It absolutely does. And it means the scope of what you, as an FR student, need to understand is broadening to include these fundamentals of sustainability reporting.
Good to know. Okay, finally, within this foundational Section A, we have Section A4 in the detailed study guide. This covers the concepts and principles of groups and consolidated financial statements. Now, this feels like a big topic on its own, but it's introduced right here in the foundational section. Why here?
It is a big topic, you're right, but it's introduced here because the concept of a group and why we consolidate is fundamental. It lays the groundwork for the practical application you'll cover in later sections, like Section D2 on preparing consolidated statements. The core concept, as the sources state, is treating a group of companies, meaning a parent company and its subsidiaries, as if they were a single economic unit.
Even though they're separate legal entities.
Exactly. Even though they are legally separate, the framework requires presenting them together in consolidated financial statements because, from an economic perspective, the parent controls the subsidiaries and they operate effectively as one entity. This combined view is more relevant for the owners of the parent company.
Okay, so a subsidiary is defined based on control, according to IFRS standards.
Yes. The sources define control based on the relevant IFRS accounting standard, IFRS 10. Essentially, an investor controls an investee if it has power over the investee, exposure or rights to variable returns from its involvement, and the ability to use its power to affect those returns. If a parent controls another entity, the subsidiary, then consolidation is generally required to show the economic reality of that single economic unit. There are some limited exemptions, but control usually means consolidate.
And the syllabus also flags up the practical aspects needed for consolidation. Things like needing consistent year-ends and accounting policies, and crucially, eliminating intragroup transactions. That's A4E and A4F.
Yes, those practical necessities are covered. To present the group fairly as one unit, you absolutely need to align the reporting periods, year ends, and ensure they all use the same accounting policies for similar transactions. Otherwise, you're not comparing like when you add them together.
Right.
And the elimination of intragroup transactions, like sales from a subsidiary to the parent or loans between them, is critical. From the perspective of the single economic unit, the group, that's just an internal transfer, like moving money from one pocket to another. It's not revenue generated from an external party.
But if you didn't eliminate them.
You'd distort the group's performance and position. You'd be overstating revenue, profits, receivables, payables, essentially double counting within the group. So elimination is fundamental to presenting a true picture.
Got it. And it also touches on concepts like using fair values when consolidating A4 and accounting for associates, A4I.
Correct. A4Is brings in the need for fair values. When a parent acquires control of a subsidiary, a business combination, IFRS 3 requires the assets and liabilities of the acquired subsidiary to be measured at their fair values at the acquisition date. This is part of measuring the cost of the acquisition accurately and establishing the starting point for consolidation. And A4I introduces associates. These are entities where the investor has significant influence but not control. Think maybe owning 20–50% of the shares.
So different relationship, different accounting.
Exactly. Because the relationship is influence, not control, a different accounting method is used, the equity method, under IAS 28. This reflects the investor's share of the associate's profit or loss and net assets, typically shown as a single line item in the investor's own financial statements rather than full consolidation.
Okay. These concepts, while maybe seeming a bit theoretical here in Section A, are clearly the essential building blocks for the actual calculations and statement preparation you do later in the syllabus.
Absolutely. They provide the crucial why behind the mechanics you'll learn later on. It makes the how make much more sense. And speaking of mechanics and practicalities, the study guide highlights some specific exam changes for this S25J26 period that are really important for anyone preparing right now.
Oh yes, I saw that. The shift regarding financial statement formats is a big one. IFRS 18 presentation and disclosure of financial statements is now the go-to standards for formats, isn't it? It supersedes the old IAS 1 formats.
Correct. That's a key change. It means IAS 1 formats are no longer examinable in FR, but the new IFRS 18 formats are. You absolutely need to be aware of this and study the IFRS 18 requirements. IFRS 18 aims for a more principles-based approach to presentation, focusing on better structure and disaggregation, particularly in the statement of profit or loss, to help users understand management's view of performance.
Right. Changes to income statement categories and subtotals.
Precisely.
And the guide also mentions that management-defined performance measures, or MPMs, sometimes called non-GAAP measures, won't be examined in FR. That's useful to know what not to spend time on for this exam.
Yes, knowing the boundaries of the syllabus is always helpful. Those are crucial practical details from the syllabus guide itself. And the overall approach to the exam, which is laid out in Section 7 of the guide, reinforces what we discussed earlier about the intellectual level. It's computer-based, all questions are compulsory, you'll have objective test questions in Sections A and B, and then longer constructed response questions in Section C. And crucially, those constructed response questions will often integrate different syllabus areas and frequently require you to discuss the appropriateness of accounting treatments or measurement bases, directly testing your ability to apply those foundational principles from Section A and use your analytical skills, not just rote learning.
Okay, so there you have it, our deep dive into the absolute first stop on the ACCA FR syllabus journey, the Conceptual and Regulatory Framework, Section A. It's really clear these aren't just abstract rules or ideas floating around. They are the fundamental principles, the core logic, the very bedrock upon which all the specific IFRS accounting standards and the entire practice of preparing and interpreting financial statements are built.
Exactly. Understanding this foundation really helps you explain why specific standards were developed in the first place, why they require certain treatments, and importantly, how they should be applied in practice, especially when faced with gray areas. It provides that critical thinking framework needed for the Level 2 analysis expected in FR.
And seeing how the framework itself is adapting, bringing in major areas like sustainability reporting with the IASB and IFRS S1, it really shows this isn't some static set of rules carved in stone. It's a dynamic field, constantly responding to the evolving needs of financial statement users and the business world.
It absolutely is. Which leads us to a final thought for you, the listener, to perhaps ponder as you continue your studies and look towards your future career. Consider this. How does having a really strong grasp of this foundational conceptual framework empower you, not just to apply today's standards, but to critically evaluate their application, especially as reporting areas like sustainability continue to expand and evolve? And perhaps how might it even help you anticipate future developments in financial and corporate reporting?